Yes, hi, Kevin Gormley here again, and today I wanted to discuss a concept. It's a story really that I heard in a book by Bogle, and the book is called The Little Book of Common Sense Investing. It's an awesome book, but he took a story from Warren Buffett, and I'm going to go ahead and tell you the story. It's a kind of a thought experiment, but consider for a second that the Hughes family, and you're part of the Hughes family. The Hughes family owns 100% of all company stock in the country. Okay, there's thousands of brothers and sisters and uncles and aunts, and you own all the equity in the country, all the stock, okay? When new issues come out, you own them as well. So what are the returns that the Hughes family gets every year? The Hughes family gets 100% of all the returns of the companies, the dividends, the increase in earnings. If earnings go up, the Hughes family gets 100% of the earnings. So the Hughes family is very happy. They're doing extremely well. They're becoming more and more wealthy. And then a couple of the Hughes say to each other, hey, I think we should buy and sell between the family and see who can, I think I'm smarter than the rest of the family members, so I want to buy and sell and do some trading. So the Hughes family starts to buy and sell within the family, okay? And what happens to the earnings and dividends of the equities in the country for that year? It's still 100%. But since the Hughes family is buying and selling, they need a broker. And they need to pay for their trades. So the Hughes family, all this purchasing, buying and selling, it costs money and it drags on their performance. As well as when they make profits, they can take, if they make profits, they have to pay taxes on capital gains, especially short-term capital gains. If they lose money, they can deduct some of it. Then one of the Hughes brothers says, hey, this wasn't very smart to buy and sell. We don't know how to pick stocks. So let's hire a mutual fund manager to buy and sell stocks for us. So they hire, some of the Hughes hire a mutual fund manager. Now what does the mutual fund manager do? Well, it puts another layer of expenses on there. And the mutual fund managers are all trying to beat each other. They're buying and selling all day long. What happens at the end of the year when the mutual fund managers are getting the costs, the brokerage people are getting the costs, what's left for the Hughes family? Well, there's 100% of the profits, once again, but when the Hughes family looks at how much they get between 60 and 70% of the profits because they've been trading back and forth with each other. So hopefully you're starting to get the message here that it is better. I mean, we all are part of the Hughes family, and a little New Jersey comment here that Hughes guys and Hughes gals that are part of this family should go for the 100%. You should try to minimize as much as possible the brokerage charges as well as the mutual fund manager fees. And the best way to do that is to own ETFs that are indexed or own index mutual funds, which no one manages. That's what an index is. Because then you can get 100% of the market. Now, when you do own these, you have to hold on to them and realize the dividends and earnings that are accelerated and that make you more wealthy. I read something recently that the SPDR, which is an ETF, is traded 4,000% per year. So if you trade ETFs, that's not going to help you. The ETF revolution just allows all of us to be able to buy ETFs and hold them for a long period of time. So if you want to play the game, it's a loser's game if you have brokerage and mutual fund managers. It's a winner's game if you own equities. Thank you.